moving on, I want to talk about funding. I want to talk about EIIS and what do investors want. And I'm delighted to be joined this morning by Laura Lynch. And Laura is coming to us from Galway. She's the principal of Laura Lynch and Associates. It's a tax and advisory business firm headquartered in Galway with an international client base. Good morning, Laura. How are you?
I'm great. How are you?
Super. It's great to have you here with us this morning, and we're delighted to have you. So maybe if you could kick us off, and if you could tell us a little bit about yourself, maybe to get us started.
Thank you very much, Conor. Good morning, everybody. So I am Laura Lynch. I'm trained as a chartered accountant and a tax advisor, and I set up Laura Lynch and Associates boutique tax advisory practice about 5.5 years ago. We're now a firm of 2 partners supported by other staff as well, and we would focus on quite high transactional stuff as opposed to routine compliance. So we do, raising funds, getting people or investor ready, exits, planning an ESOP, share option schemes for companies, that kind of thing as well. I'm also the main advisor into Halo Business Angel Network. We would advise and we manage the MedTech and the Bloom syndicates at the moment and offer both administration and transaction support. I'm also on the board of the Irish Tax Institute, and I'm on the direct talc committee with revenue as well, whereas we have big discussions in relation to technical issues and we try and influence change in the legislation and policy and practice. Through that role, and I suppose through my business angel role as well, I was involved in negotiating several finance bills, and my tenure in doing that coincided with some of the biggest changes in EIIS since 2015. So for my sins, I've become very well versed in everything to do with EIIS and the pain that's involved, but equally the benefits to companies too. I suppose we offer a nice bridge between investors and investee companies. I'm technically a startup myself, so I empathise with everything you go through. But we also help people, I suppose, understand the terminology, understand what's involved, whether you're an investor or an investee company raising the funds, if you're going down the EIIS route, or indeed any source of finance really, and how they play out and what to expect when you go in and make your pitch and people start asking questions about you and your business and your forecasts. So hopefully what I have to say or what I'm asked about this morning would be of interest.
That's some intro, Laura. Thank you so much. You're a busy person. Let me just ask you, if I could jump in, from your perspective, what does being investor ready mean? As you're thinking about maybe going in front of HBAN, or you're thinking about, we'll come to EIIS later. So maybe talk about, you're going to investors. What does investor ready mean?
Excellent question. I suppose the first thing people invest in is the people, so you need to have a good business proposition. You need to show that there's an element of scalability to it. So there's some really great innovative things happening, but in terms of the financial growth that it'll drive, it might be a very good kind of cottage industry or lifestyle business for you, but it mightn't give the kind of growth and return that an investor would want. So you need to be very clear about what it is you're offering, what is your USP, what's different about you, what is the competitive landscape like? Why are you different? Are you a disruptor? What kind of market adoption have you proven already? I've seen more and more recently that, particularly in the medtech field, it's not enough now just to prove your technology. You need to prove that somebody's prepared to buy it, and particularly where you're entering into places with limited budgets like hospitals, etc. as well. You need to be very clear about what your IP situation is, and just to ensure, you've got freedom to trade, that you're not infringing anything in that respect as well. Your business plan is key, obviously. You need to go through all those different elements. You need to be realistic, I suppose, in terms of, what you think you can achieve and what it's going to take in terms of cost and personnel and timing to get there. From an EIIS perspective, you have to have quite a detailed business plan. So I know a lot of people might have a pitch deck and a lovely PowerPoint presentation. That's not enough for the revenue commissioners in terms of going to market looking for EIIS. You need to think about the team. Who do you need to get on the bus? Who's on the bus already that's going to drive you from A to B in terms of achieving your goals? And to be very honest and realistic in terms of the gaps that are in the team at the moment. And that can be either people on payroll, or it can be your advisors or people like that as well. It doesn't always have to be people in terms of headcount. Just what expertise do you need to get that bus from A to B, and who needs to be on the right seats at the right point in time?
Very good. Can I move on from there? So you mentioned kind of the business plan, and you mentioned the pitch deck and the financial model. But from your perspective, and you're advising kind of HBAN out west and generally, what does that process look like? Maybe just give us a sense of actually what do I need, or at what stage do I need to be at to get in front of investors to pitch to them?
I suppose we would deal with a lot of high potential startups who might already be in a program like the BioInnovate program, or some, like the Trinity or Cork or something like that. So that would already give them exposure to potential investors or strategic investors and people like that, attending things like networking, medtech brews, etc. Hopefully, once we can all get back into proper face-to-face networking, that's really, really interesting to do before you're even ready to go to investors. If you're meeting people at events like these, that you're able to tell them, this is what I'm looking at, this is what I'm researching at the moment, and this is what I plan to do over the next 6 months. And then when you do get to pitch to them in 6 months' time, and you can show you've delivered, you said what you said you'd do, and maybe you've done it in a shorter time frame, or you've achieved more in that time. In terms of when is the right time to go to investors, it's a lot of it kind of goes back as well to your valuation. Like, how much can you achieve by bootstrapping before you start handing away some of your company and some of your equity? So anything that you can do to add value and create value in your company without giving away equity is really, really important. Any non-equity based sources of finance, like awards and prize money or grant aid or going down, Horizon 2020 or anything else in terms of feasibility studies, whether it's Enterprise Ireland or or something like that as well. They're really, really interesting forms of finance that can springboard you to a point in time where you are an investable proposition. You're more than a concept. And like I said earlier as well, in terms of testing the market and showing some level of market adoption for what you do, which would be very different depending on what sector you're operating in. And
the flip side of that then is, what are the investors looking for when I'm sitting in front of them, I'm pitching? What is it what's the one or two things that an investor is going to say, yeah, this looks like an attractive proposition?
The first, I suppose, is know your audience. So again, if you're presenting to a sector-specific group like a medtech or an ICT or something like that, you really need to know your topic. You need to know your product. You need to know your market. You need to know what is the best route to market. Is it a distribution or direct sale basis? So they'll be looking at that, and they can really nail you to the wall because they are experienced investors a lot of the time themselves. Sometimes they're not. Sometimes they're just guys who want a tax break, and they don't really care what you do as long as you're going to stay in business for 4 years and they get a tax break on the way in, which is the EIIS. So it's no harm maybe to have somebody check your business plan and things like that, somebody like myself or a tax advisor, just to see if that's even something you can offer to investors. What can be actually kind of unhelpful is when you do start talking to investors and you promise them that you look into EIIS or you see if you're EIIS compliant, you have created an expectation then in their mind, I suppose, and if you subsequently then can't offer it to them, or for some reason you don't comply, you've, number one, potentially wasted a lot of time in engaging with that cohort, and number two, you've not delivered on a promise. That's never a good start. And number three, you kind of need to go elsewhere then, so if you've decided or you find out at an early stage you can never qualify for EIIS, that's great, because then you don't start putting your energy into that cohort and you can look elsewhere. The other thing investors look for is the team. It's very interesting to watch it, when you're in the pitching room with the investors and the client and the people pitching, they kind of take it as a given, your technology or your market or whatever, but it's very much, is the CEO the right person at the helm? Do they have the skill set to deliver what they need to do? They may be a very good technical person, a great researcher, a great guy or girl in the lab, but do they have what it takes to be a CEO and lead? And do they have those leadership qualities, or have they recognized, we have a gap in our team for that, and there's space in the budget for that as well. So very much around the team. You often see great ideas fail because the wrong people are executing them, and you see only, mediocre ideas doing really, really well because you have an exceptionally strong team behind it.
Very good. You've mentioned it a couple of times now, so we've no choice but to jump into it, Laura, into EIIS. Will you firstly explain to me, as a novice, what it is?
Okay, so it is a tax break for an individual, and it basically means if I'm putting 100,000 into a company, the revenue will give me 40 back, so it's only really costing me 60,000. And I can write that off at things like my salary or my dividends or my rental income or something like that as well. So it's a tax break. It's a tax break for individuals.
It's a tax break for individuals who are going to invest in your company. Is that? Am I clear on that?
Yeah. And they have to do that by way of subscribing for shares. So you can have ordinary shares or preference shares. So things like convertible loan notes, you might hear terminology like that, or, preference shares that have like really good commercial rights attaching, they mightn't qualify either. You might acquire shares when your loan converts, that doesn't qualify either. So it needs to be pretty plain vanilla stuff for it to qualify for EIIS in the year that you make that investment. An investor can put a maximum of 250,000 in per annum to qualify for EIIS, as long as they hold the shares for 4 years. There is a part of the code that says they can put in up to 500,000, but those shares need to be held for 7 years, or they lose all their tax relief if there's an exit in that period. So what we would normally do there, if somebody wants to put 500 in, you put in 250 New Year's Eve and 250 on New Year's Day, and you spend 2 tax years then, and you still only need to hold those shares for 4 years without fear of losing your tax break in that time.
So it seems, as a company, as an entrepreneur starting a business, getting eligible, if that's the word, for EIIS is an absolute no-brainer, because for the investor who's coming into the company, there's a significant potential tax break that comes with that. What does the company have to do to become EIIS eligible?
It is quite complicated, and I suppose that's one of the issues that we have with the EIIS and how it's evolved over the years. So it's a no-brainer at the moment for the investors because several improvements have been made to the scheme and they've been very investor forward. The corollary of that, though, is that a lot of the risk has been pushed over to the investor company, the investee company themselves, raising the funds. So if I'm a company taking EIIS money in, I'm the one who has to sign the certs and tell everybody everything's okay. And if I get anything wrong, I have to write a check to the revenue commissioners for your tax break. You get to keep it. So it's very important a company understands at a very early stage what's involved if they do decide or make that strategic decision to raise EIIS funds. What we would normally do, so EIIS is very complicated, and it is roughly 45 pages of very small print legislation supported by 95 pages of revenue guidance notes. So it's, I would say, impossible for somebody with no tax knowledge to do EIIS. And there's very few firms actually, even within the tax advisory world, that do it. So I suppose that tells you itself that it's terribly complicated. What we would normally do is start off with a company just to do a very high level overview of some of the key conditions that need to be met if you're going to offer EIIS to people. And if you find a showstopper, then you just down tools and you just go, no, you can't do this. Don't even bother. Either from a risk perspective, or there's a fundamental condition that you can never meet, or whatever the case may be. And that saves a company an awful lot of time and expense and lost potential investors at a very early stage. If you go past those key criteria, then a further deep dive needs to be done into things like your business plan and what do you need the funding for, when was the company established, They're all key criteria that the company needs to meet in the context of qualifying for EU state aid rules. You need to meet those as well as our own domestic legislation rules. So that's kind of what the process is involved. And then what happened was a couple of years ago, Revenue used to sign off on EIIS and send out the certs to investors. And for various reasons I won't go into, there's been a huge amount of delays in that. To counter those delays, what happens now is Revenue don't send the certs out. You as a company have to send the certs out. You have to certify that you're a qualifying company and that you're spending the money on what we call a qualifying purpose. So you need, I suppose, to be very clear that you are a qualifying company. You need to be very clear about what that entails. There's also conditions that need to be met for the following 4 years that you have those funds in place. You need to be very careful in terms of, if you're raising EIIS in this year, do you think you'll be going back to the market and offering it again? Because there's certain things you need to do today to make sure that your future funding round will qualify for EIIS again, and particularly if you plan to go back to your existing investors, hoping that they will follow their money rather than have to go out to strangers as well.
Very good. Laura, a question in from our audience there, and we're happy to take questions, so keep them coming. The SAFE instrument is becoming more popular in Ireland. Is it compatible with the EIIS?
There's conflicting views on that. I've only seen one instance where it was used or hoped to be used, and that in that particular instance did not qualify. It is being used. I've seen it offered as an instrument more and more, but not on a particular EIIS project that I've worked on yet. Okay. And Revenue haven't come out on it either. I would anticipate it mightn't, on the basis it's akin to like a convertible loan note, in that the funds are given up front and then at a later stage you'll be offered shares. So it'll be interesting to see if Revenue express an opinion on it.
So it's a grey area at the moment. Okay.
Yeah. There's no definitive answer yet.
Okay. Another question from our audience. What if the business is sold before 4 years, before the term is up?
Mm-hmm. Yeah. So if I'm an investor and my shares are sold within 4 years, I have to pay back Revenue the tax break that I got. So in that circumstance, the investor, has to pay back the tax break and not the company. So that's a good thing. Hopefully I'll have plenty of cash from the exit to fund that relatively smaller tax break. That's obviously the reason that you would enter into that. What I would say though for EIIS, again, it's about suitability, like matching your sources and uses. If you're a company that expects you'll exit within 3 years, you just need this accelerating funding to do so today. EIIS is not for you because you know those shares are going to be sold within 4 years. So there's no point offering EIIS.
Okay. Another one, there seems to be quite a lot of interest among the audience on this. How much does it cost to get an EIIS assessment on this self-certification that you're talking about?
You'd have to approach a tax advisor to give you a fee quote on that one.
Yeah. So